What can be those out-of-the-box solutions at these uncertain times? Let's find out in this first debate that we have for you on Urban Debate on Mirror Now this evening. We will be joined by my guest this evening, Aditi Nair, Chief Economist at ICRA, Dr. Santosh Mehrotra, Senior Economist, Professor Arun Kumar, Senior Economist, and Nikhil Gupta, Chief Economist, Motilal Oswal Group, is also going to be joining us in just a bit. And that's going to be our key focus. What are the kind of out-of-the-box solutions can one really now look at? Aditi, good evening. Thank you for joining us here on Urban Debate on Mirror Now. Firstly, your opening comments on the GDP growth data that was released today, and was it as per your expectations?
Thanks, Hina. Today's GDP growth release for Q3 was definitely below our expectations. We had penciled in a 6% GVA growth and a 6.2% GDP growth for this quarter, and the big negative surprise has come in from manufacturing, which is pretty much flat on the previous year's levels, and a contraction in construction, which again we're a little surprised, even though it was a very rainy quarter and there was a lot of disruption in southern India, but we had not expected to see a contraction in construction. Now, if we look at the second advanced estimate for FY22, this has come in at 8.9%, which is broadly what we expected when the third wave had started. But what is now implicit for Q4 seems to be a little too high, given the fact that on top of a modestly disruptive third wave, we're now entering into a period of geopolitical tensions, which have really pushed up commodity prices. And with demand being tentative, it's difficult to really foresee price hikes coming in this quarter to be able to offset this commodity price impact. And therefore, margins are going to be under severe pressure in Q4. And we do now think that the full year FY22 GDP growth is likely to be somewhere in the range of 8 to 8.5%. So a little bit lower than the second advanced estimates of 8.9%.
Okay, so you're expecting growth to be even lower than what the government is expecting for the current year. You see growth to be around 8 to 8.5%. Professor Arun Kumar, how do you see the numbers that were released by the government today, and how, in your opinion, this uncertainty, in fact, has become the new normal and India really needs to now probably think out of the box?
So you are absolutely right. We are all predicting in a very uncertain world. We didn't know that Omicron would come. We didn't know that the Ukraine war, would come now, which will affect the Q4 data for this, few months. So in a sense, prediction has become very, very difficult. And more so because you see the data for the quarterly data is always a partial data. It's coming from the organized sector. Doesn't take into account the unorganized sector. Now, even if for a moment we forget the unorganized sector and its decline, then what this data shows is that we are just about 1.5% above the 2019 level. That means we are roughly where we were 2 years back. So even though we've grown over last year when there was a lot of disturbance in the economy, but if we compare, with 2019, which was a normal year, then we have just about come back to that as far as the organized sector is concerned, which is very concerning, because if we then include the unorganized sector, which has been declining, for which the data is not included here, then, we would see that the growth is much less than what the government is saying. And also, as Aditi has already pointed out, if you look at the GDP numbers, it's surprising that, if you look at the April to December numbers, then our private final consumption expenditure is down, our government final consumption expenditure is down, the gross fixed capital formation is just about where it was in 2019, this period, April to December. The only thing that has risen is change in stocks and valuables, which is really not very, very healthy. So all in all, the Q3 data is not very encouraging if we compare it with 2019. And as is already being said, if inflation has kicked up, inflation is likely to kick up further with the Ukraine war, and that will pinch the pockets of the consumers, and especially the people who've lost employment. And as the recent data which has come, which says that large number of people have lost employment and incomes, and if inflation kicks up, then the demand will come down further. And if you look at the data on demand, the consumer confidence is still way down. It's at about 62 compared to 105 pre-pandemic. So consumer confidence is not yet back. Capacity utilization is still below 70. So that means that investment is also not likely to pick up very rapidly. And if consumption and investment don't pick up, then of course the growth will be affected. And the Ukraine war, if that is creating global uncertainty, stock markets decline, for instance, capital starts going out of the country because, quantitative easing maybe, not there in the US, the interest rates may rise. And if capital goes out, stock markets, start going down, then investment climate would also be affected further. So all told, it's a very uncertain world. Things are not looking very good. So government is needed to come in, and government must spend, give purchasing power in the hand of those who've lost employment. That's when consumer confidence will rise. So I think rather than look at the long run, what the government keeps saying is we are looking at supply side. But supply side is always medium to long term. It doesn't have an immediate effect. And it doesn't work if the demand is inadequate. So I think that it's needed to boost demand, and that's what industry is also saying. I mean, the FICCI new president has said that we need to create more employment in the urban areas, we need to create more employment in the rural areas, so that we can give purchasing power in the hand of people, those who've lost employment and incomes. Then, the demand will come back, and then the private sector will start investing more. If the demand is low, then why would private sector invest more? It's only the government which can invest more. And unfortunately, even the government's, plan for the budget, even though 35% is slated as the increase, a lakh crore of that is actually states. So that's double counting. And it doesn't look like that the very big boost is there which can compensate for the decline of investment in the private sector. So all told, the government has to pitch in much more. The budget is rising by only 4.6%, which is below inflation.
Government has to pitch in much more. Government is needed to come in. That's what Professor Arun Kumar feels. Nikhil Gupta, what do these numbers really tell you? Because, the problem of unemployment remains, uncertainty still remains, and now the expectations that we had of certain macroeconomic indicators for the next year, for this year, with which the budget, was finalized for the next financial year, have all changed, all because of the uncertain times that we are living in, because nobody had expected that there's going to be a war between Russia and Ukraine when budget was being presented.
Yes, thank you, Hina. Thank you for having me on the show. So, Hina, as Aditi and Professor Kumar has already mentioned, today's number was lower than expected, what the market was expecting. And the full year FY22 growth estimates have also been revised downwards. However, if we compare what the government has taken into their budget estimates, which is close to 11% growth for nominal GDP for FY23, and if I remember correctly, 16.5% growth for FY22. I do not think that there is a risk for downgrade in these estimates, especially for FY22. Yes, the real growth estimates have been revised down slightly from 9.2 to 8.3%, but the nominal number is expected still to be close to 16.5%, at least we expect so. And for FY23, although the market consensus when the budget was presented, the market consensus was 12.5 or 13% roughly. The government was slightly conservative in their forecast, and they had taken 11.2% growth, which I believe is something which we can continue with, even considering the fact, even considering the Russia-Ukraine war situation, which is evolving, very dynamic at this stage. Very difficult to put it into our Excel and reduce our GDP growth. So I do not see any concern over there. But yes, today's number definitely confirms the fear that we had. I mean, we had estimated Q3, that is today's number, which has come out for December quarter. We had estimated real GDP growth of 5 to 5.5%. To be precise, we were at 5.3%, and it turned out to be 5.4%. And we also were expecting Q4 number to be closer to 5%, and the government now expect it to be close to 4.8%. So the way I see today's number is it is more in line with what we were expecting, which was more a reflection of the fear that the economic revival in India has not been as strong. It is definitely nowhere compared to what it has been in most of the Western countries or the advanced world. And the biggest difference, which we all know, has been the fiscal stimulus. Our fiscal stimulus was very limited because of our structural constraints, and the fiscal stimulus was really massive in most of the advanced countries, and which is what is reflecting in the growth differences that we are seeing right now in India vis-a-vis most of the advanced countries.
Okay. Dr. Santosh Mehrotra, government we know has been indulging in a lot of Labharti politics or beneficiary politics. Do you think, that in a way needs to change now? Because going by the data that we've got, going by the fact that we are living in times of uncertainty, these clearly, it seems, have failed to provide impetus to the economy, and in a way have started undoing the benefits as well that these Labharti policies or beneficiary policies, have been having.
Well, it's a tragedy that economic policy in this government for the last 8 years has been a victim of politics from the very beginning. But let me just pick up on the point that Nikhil made about our fiscal stimulus. He's absolutely spot on. But I think the comparative is for us are not the rich countries where the size of the fiscal stimulus was something of the order of 8% of GDP, 6 to 8%. In our country, it was 2.1%. I think the comparator for us is the emerging market economies. The emerging market economies' fiscal stimulus size was 4.7% of GDP. That's where the foundational problem is, and we are now beginning to pay the price for the very, very limited fiscal stimulus, something which we have been arguing for the last 2 years. And that's the reason why Arun is pointing to the difference in the way the unorganized sector is reacting and the organized sector. The organized sector is doing reasonably well, thank you very much. But look at manufacturing, look at construction. These are the two sectors in which a very significant proportion of all output and employment is located, and it's located in the unorganized sector. Please try and appreciate and understand this clearly, that if a very significant proportion of output and employment in both construction and in manufacturing is in the unorganized sector, and if the government's not doing enough, either on the supply side or on the demand side to stimulate aggregate demand, then you're going to see the poor performance of manufacturing and construction that you've just seen in the latest data, in the quarterly data. So, look, we've got to get our economic policy right, otherwise you will continue to get a K-shaped slow recovery, and that's no good for the vast majority of our population.
Aditi, do you also believe that, the focus now needs to be on out-of-the-box solutions? Because, the conventional fixes do not really seem to be helping. And as I was mentioning earlier, on one hand, either we can sit out and wait for this uncertainty to, get over and then think how we want to fix the economy, or there is another option of, pressing the accelerator button so that, we move ahead no matter what the hurdles are and we are able to cross those hurdles too. What is it that's needed? Because the numbers in a way are not reflecting what's happening on the ground. There is distress, we understand that, but still we are talking about 8 to 8.5% growth as you're mentioning, but on the ground there is some sort of disconnect.
So Hina, if you'll allow me, I'm going to play a little bit of a devil's advocate and point to two things which I think are a bit of a silver lining. One, I'm going to pick up from what Professor Kumar said about the consumer confidence data still being very, very much below the pre-pandemic level. But if we look at the latest number for January and compare it with November, even despite the third wave having started, there isn't much of a further negative which we see. So my limited silver lining takeaway is that at least people are now sort of resigned to the pandemic, or perhaps better prepared to deal with fresh shocks. And this is something which I think, we do need to not overlook it. I think it is significant that we didn't have a big fresh hit to consumer confidence from the third wave. The other thing, what Dr. Mehrotra just talked about, I completely agree. If we are in a situation where there is a K-shaped recovery, no matter how we look at it, sector-wise or within sectors, large versus small, organized versus unorganized. However, the way that direct taxes are growing is benefiting from the organized players doing better at the cost of the unorganized, no doubt about it. But it does give more money in the hands of the government to be able to spend. And that is again, it's a silver lining. That's all I want to say. Now, looking ahead, the budget clearly did try to focus more on capital expenditure. And I agree that there's a large execution risk that we've now put in the hands of the state governments. This 1 lakh crore loan for capex, will all the states actually want to take this money from Government of India? Will they be able to spend it fast enough? Because the growth impulse will come in, particularly if the spending starts early. And we have shifted a lot of this risk onto the state governments, who present their budgets later than Government of India and whose capex generally tends to take off a little bit slower. So it remains to be seen whether we're going to have this big push to capex starting early enough that the first half of this year, with all the other attendant uncertainties that are there, can show anything other than a base effect-led growth.
Okay. Professor Mehrotra, clearly, as Aditi was mentioning, some silver lining is there, but maybe it's not clearly visible. But given the uncertainty that we have at this point in time, what is your suggestion to the government? The time to spend this 1 lakh crore that the finance minister spoke about during the budget presentation is now and not maybe in the future, isn't it?
I assume that you're talking about the 1 lakh crore capex 50-year loan that has been extended to state governments. And honestly, that's a good idea, and I'll tell you why that's a good idea. You see, state governments in any case undertake more of the public investment than the central government. Historically, that is the case. The more important point from the view of aggregate demand is the following: that state expenditure on capex is more decentralized, it's more labor intensive. Central public expenditure, central government's capex is more capital intensive, doesn't generate that many jobs. So that's a good thing. Having said that, the bottom line is that, and I refer here to the point that Aditi was making, I just want to emphasize that GST revenues have been rising on the strength of the organized sector recovery and on the strength of the profits of the listed companies and so on. What has happened now over the last 5 or so years is that the share in total revenues, total tax revenues of the central government, contributed by indirect taxes, including GST, has overwhelmed the share of the direct taxes. This was not the case. This never used to be the case. In other words, this is completely regressive. In other words, you are taxing the vast majority who've already lost jobs, whose aggregate demand has fallen, whose prices are rising, and you want to tax them? Why are you not imposing a surcharge on the incomes of 1 crore plus per annum personal income tax, and why are you not imposing a surcharge on corporate tax? You brought down the corporate tax in mid-2019. Have you seen a private investment bump up since then? No. This was promised, the 30% to 25% fall in corporate tax was promised in 2015 by Finance Minister Arun Jaitley, 1 percentage point to be dropped every year over the next 5 years. That didn't happen. It happened in mid-2019 in the midst of a declining economy. Did the private investment increase? No. The government has lost about 1 lakh crore after you allow for the exemption elimination. It needs to push back up temporarily corporate tax. It needs to. There's just no getting away from that. It needs to put a surcharge on personal incomes above 1 crore per annum. The government needs revenues. Its fiscal deficit has risen. Its debt to GDP ratio has risen. this is not an acceptable situation that you are impoverishing people on the one hand through your tax policies, raising taxes on petrol and diesel and gas. This is counter-cyclical. This is the opposite.
I would like Professor Arun Kumar to now also weigh in on this. You're saying that government needs to push up corporate tax rate once again. There's a need to increase the size of the pie actually than merely correcting the imbalances. Professor Arun Kumar, that's the idea of really speeding up. Do you agree?
So, what Santosh is correctly pointing out is that they need to shift from indirect taxes to direct taxes, Corporate tax is a direct tax, income tax is a direct tax, and as the Prime Minister said in his 15th August speech, that effectively only 15 million Indians are paying direct taxes. So even though about 55 million or 60 million may be filing income tax returns, but most of them file either nil return or very low return. So effective number of taxpayers is very small, and that number can be pushed up, and these are the people who gain. Stock market has gained enormously. Corporate profits, if you look at the RBI data of 1,500 companies, their profits have been going up 22-24%. Whereas the rest of the economy is actually suffering. So that's where you need to raise resources. If you don't raise resources there, where else will you raise resources? And you don't want to increase your borrowings, so the only way is that you get more resources. Now, coming back to another point on this, while the GDP growth in the budget has been taken at 11.1%, but the point is that the expenditure is rising only 4.6%. So if the expenditure rises 4.6%, which is less than the expected inflation of 5.5%, that means actually you're not boosting the total expenditure. And if you're not going to boost the total expenditure, then the stimulus would not come. So I think, it's not just the question of 11.1% GDP growth that is assumed, and that may or may not be the case. And if that comes from inflation, then that would create its own fiscal problems, because even though the revenue and the expenditure targets will be met, but in real terms they'll not be met. So, and what you need to do is, in real term, you need to boost the economy, and therefore that is very necessary. And then you raise the question of Labhartis getting money, and you need to put money into the hands of people so that demand can increase. But think of the World Bank. World Bank has been talking about the safety net, because World Bank realizes that its policies will lead to greater poverty and the lack of income in the hands of people who are at the bottom. So they have been talking now of UBI, Universal Basic Income. So if the Labhartis are getting far less than what the Universal Basic Income would imply. So in a sense, globally it is now recognized, and the rich people in America, rich people elsewhere are saying that we need to be taxed more so that the money can go to the hands of the poor people. And if for instance, if you think of Ford Motor, when Ford T model came, Mr. Ford said, if my workers cannot buy the Model T, then I can't sell, I can't mass produce. Because if I mass produce, then my workers have to have the income.
Absolutely.
So therefore, you need to generate more employment. You need to generate. So if you can create productive employment, do so. But in the short run, you need to give money in the hands of the poor people, whether you call them Labhartis or whatever. So I think what is necessary is that you cannot wait. While there's an uncertainty.
But my question, Professor Arun Kumar, then is, how has that really helped? It hasn't solved the problem of unemployment in the country. The government talks of direct benefits, but public complains of high prices then.
No, Hina, but as Santosh has already pointed out, you didn't do enough. The stimulus was very small. If you gave a much larger stimulus, then the demand would have come up much more. So like, for instance, in the rural employment guarantee
So you do not think that we need to think out of the box, as Professor Mehrotra suggested, that probably this is the time to further push up the corporate tax. You are saying that more money needs to be given via DBT.
And you raise money through direct taxes. What he's talking is corporate tax, and there are other direct taxes also that you can raise. And the point I'm making is that in these uncertain times, government has to act, because the private sector will not act in uncertain times. So it is the onus is on government to have a much larger stimulus, because the private sector investment will not rise otherwise. If there's a lot of uncertainty globally and there's a lot of uncertainty in the Indian economy, why would the private sector take on the risk? They can't take the risk, so government has to do it.
Okay.
So as you said, that there's greater uncertainty, and in this period of
Nikhil Gupta, usually private sector gets contracts when government spends money. When there is expenditure from the government side, that creates jobs. But unfortunately, the private sector has been remaining very soporific. Is there a way out?
let me take a step back. And I heard Professor Mehrotra, I heard Professor Kumar, and I mean, this is a general consensus that it's the government's responsibility to spend more at this time to stimulate the economy, so that what you just said, that the private sector gets more confidence to spend. The problem here is there is no free lunch. I mean, we saw that on the budget day. As Professor Kumar mentioned, that the spending growth is expected to be extremely minimal for FY23. Still, just because the fiscal deficit number was so high, we saw bond yield moving from 670 to 695 in just a matter of couple of days. Right. So as I mentioned, there is no free lunch. We all want the growth to go up, but if the government actually spends more, and if they actually borrow more, then we will be having the same arguments on the other side, that why is the government doing so much when it is hurting the debt market? Because again, government debt to GDP ratio combined central and states is close to 90% of GDP. The question is, if the government spend, it is possible that if they garner more resources, like Professor Mehrotra pointed out, that they can increase the corporate or put a surcharge on the corporate income, or they can raise more resources through any other way, then they do not need to borrow more, but they can spend more and keep their fiscal deficit and borrowings unchanged. That is okay. But the question is, if the government spends more, then there is a likelihood, depending on the way they spend the money, there could be inflationary pressures. Right. So, for example, as Professor Kumar mentioned, that if we do more DBT, cash transfers in the people, this is exactly what has been done in most of the Western world. And that is why the situation in the Western world at this point in time is very different from the situation that we are in today. They have very high inflation, they have very high growth. Okay. There is serious overheating that is happening in those economies because the government overstimulated. That is not the case in India. Our growth is weak, our inflation is not very high. These two things move hand in hand. So tomorrow, even if there is fiscal stimulus without a concomitant or a corresponding increase in borrowings or fiscal deficit, there could be inflationary pressures, and then it will lead to another set of problems. So that's why I mean, it is not a very easy riddle to solve. It is an easy solution that, okay, the government must come in and spend.
That is why we're talking about probably out-of-the-box solutions are needed at this point in time. The conventional fixes are not going to really work because we live in uncertain times. Aditi, now, the wise minds clearly are saying indirect taxes are a hidden cost, which is a fact, because Labharti on paper gets some money, or benefit, but loses it in indirect taxes. Should inflationary concerns weigh heavy over the policies that we have today?
Let me add one more policy option to everything we're discussing. Clearly, crude oil prices have run far ahead of where the pump prices are for diesel and petrol. And there are lots of forecasts out there. It's very difficult to pinpoint. But we think that the lag revision which is required in petrol and diesel prices is probably of the order of about 6 to 8 rupees per litre. And this is in the ballpark, how much excise duties are higher than the pre-pandemic levels for these two fuels. So one more policy option that could be there, let's go back to the pre-pandemic level of excise duties, do a complete rollback. It's going to cost the government about 92,000 crore, and it's at least going to stave off a shock to inflation. And that's another alternative to raising direct taxes by 1 lakh crore to reduce the regressiveness that we have right now. How about we look at reducing the indirect taxes by 92,000 crore by just resetting to the excise duty levels which were there before the pandemic.
Okay, interesting. You've also given us a very interesting suggestion. Actually, the election season to get over, because that's when the fuel prices are going to start burning our monthly budgets. But Professor Mehrotra and Professor Arun Kumar, we know that, spending power needs some sort of mending. Your suggestions for the government, what are the ways that the government can consider for doing this?
Spending on what? Are you asking us spending on what?
Spending, the demand that needs to be generated, how to push spending in the country to have the economy, start picking up.
Right. So first of all, I think I fully endorse what Aditi was saying. It's absolutely critical that pump prices have to drop. They shouldn't have been raised to this level in any case, and that's been driving inflation, and that's not a good thing. So, I mean, that's my response to Nikhil about his worry about inflation. So that's point one. Because if you push petrol prices and diesel prices down, it will have a impact on inflation, which is good from the point of view of the vast majority. I'm saying reduce those indirect taxes on these two particular products, but also mobilize resources so that your fiscal deficit can be reduced over a period of time. You don't want a crowding out, which is what I think both Nikhil and Aditi should be worried about. You don't want a private sector crowding out with the government borrowing too much. We don't want the government to be borrowing much. We want the government to increase its tax revenues. It had already made a mistake in budget of 2019, just before the elections, in order to win over the middle class, by raising the threshold of personal income tax, knocking out 75% of taxpayers, personal income taxpayers. That was an outrage. That was a complete outrage. You know, what developing countries normally do in order to raise their tax base, personal income tax base, is to leave the threshold where personal income tax kicks in at the same level in nominal terms, so that as, with inflation, as people's, wages rise, salaries rise, they begin to come into the personal income tax. They pay a pittance of a tax, but they get used to the idea of paying tax. And whatever small amount it may be contributing, the point is that over a period of time, boond se ghat badhta aega. So that would have helped. And therefore, what we are suggesting is what we had put in place in 2008. In other words, cut taxes and increase spending. It's very simple. It's straightforward macroeconomics 101.
Cut taxes, increase spending. Okay, Professor Arun Kumar. Now, going back to the issue of fuel that Aditi had, talked about earlier, fuel pricing clearly is another conundrum. Government charges huge levies on fuel. The money it gets is actually pumped into, the welfare policies. Is that good economics or good politics in your opinion? And do you think government should now bite the bullet and, take a hit of this 92,000 odd crore rupees? Will the government be in a position to take this kind of a hit?
I think, what everybody's pointing out is that while you reduce indirect taxes, like for instance on fuel, you can't reduce other indirect taxes because you have to go to the GST Council, but it can be flagged as an issue that in the next GST Council you talk about other basic items also, reducing the indirect taxes. But at least here you can reduce the indirect taxes directly on the fuel, but you need to raise resources, as Santosh is correctly pointing out. It's all fungible. When the whole money comes into a pool, you don't know what money is going where. So it's not as if you're collecting from GST and spending it on the education and health sector. You have education cess and other things also. So the point is that, you raise the total kitty that the government has, out of which you do extra spending. And that, one suggestion that we made is corporate tax collection, because corporate sector's profits are growing at 22-24%. Everybody else's income is going down. Their income is the one that's going up. Their pricing power is increased, So in spite of some costs going down, they're raising prices. So you can do that. Also, the RBI has been complaining that there's excess liquidity in the system, which the banks have. So, why is that? That's because your credit offtake has not been going up very much, given that the investment rate is down, given that the production is down. So therefore, it's not as if, you cannot borrow more. You can borrow more, but it's more preferable to actually collect more direct taxes, like from income tax or corporate tax and so on, and cover your deficit out of that. That's a better way of doing it than just doing borrowing. And you have to give money in the hands of the people so that the private sector demand starts going up. And in fact, FICCI and CII themselves are saying that you need to put more money into the hands. How do you put more money into the hands? You do labor-intensive project like Santosh right in the beginning said, rather than go for big capital-intensive projects, go for small projects, decentralized projects which are not so capital-intensive and will employ more labor. And therefore, you can put money into rural employment guarantee scheme. RBI's data shows that in the rural employment guarantee scheme, people are getting only 50 days of work, not 100 days of work. and their wages are less than the minimum wages. So they are subsidizing the infrastructure creation. So the poor people are subsidizing rather than, actually getting, the minimum wage that they should be getting. And people are also suggesting an urban employment guarantee scheme. Now, urban employment guarantee scheme is difficult. No doubt, there's no doubt about it. But you have to attempt the difficult because these are very difficult times. There's a lot of uncertainty. Economy is down. People are feeling down. The consumer confidence is down. So I agree with Aditi that, things may be a bit better. But most of the consumer confidence data comes from the organized sector, not the unorganized sector. So the unorganized sector where there's a lot of loss of employment.
But interesting point you're making, Professor Arun. But Nikhil, when the budget announcements also came, overall the sentiment remained positive and many people were of the view that these will help boost demand. That's what the government also felt. It will improve spending by public. In your opinion, is spending as a habit now going out of vogue because there is uncertainty both economic and due to the pandemic? And is that actually making people save more when they are provided some sort of incentives or some sort of direct benefit transfer for that matter?
Okay. Heenal, after the budget, as Professor Kumar has already pointed out, the spending growth, the budgeted spending growth for FY23, if met, if I remember correctly, it will be the lowest in almost a decade or so. It is only budgeted close to 4% or something like that. Now, the point is that there are 3 points that I want to mention. First, we are at this point in time, I think most of us are focused only on the central government finances. Right now, I want to put one data point here that the central government finances in the first 9 months of FY22, that is April to December 21, it amounted to 8.8% of GDP. I'm talking only about central government's total receipts, 8.8% of GDP, which is similar to what it was in FY08, which is by far the best year we have had in terms of economic growth. Right now, we know that our economic situation is nowhere close to where we were in FY08, but still the central government's resources are similar. Right. And at the same time, the second point that I want to make...
I was referring to spending by public.
Yes, I know. So spending by public, see, if you have resources, the point is the central government's fiscal deficit was 9.2% in FY21. Now they're telling us it will be 6.8% in FY21 and they have a plan to reduce it to 4.5% by FY26, which means they are planning a fiscal consolidation of more than 50 bips of GDP every year. Now we need to understand that between FY15 and FY19, that is pre-COVID, the government struggled to bring down its fiscal deficit from some 3.5% to 3% of GDP. So even a fiscal consolidation of 10 bips of GDP was a very tall task at that point in time.
Right.
Now the government is saying that over the next 4 to 5 years, I will be consolidating my fiscal deficit by as much as 50 bips of GDP, which means that even though your resources are the best that you have seen in FY08, your resources are similar, your spending growth has to be lower, otherwise you will not be able to consolidate your fiscal deficit. Right, so this is again a point that I mentioned earlier. If the government, for example, let's say
any
the government has...
out-of-the-box solution that you can suggest, just like Aditi has given us one, just like Professor Mehrotra has given us one.
Okay, so I do not have any solution which does not have any associated costs with it. So I believe if the government, if we want higher GDP growth, if that is the sole objective that the
even Aditi's solution was quite expensive, 92,000 crore rupees.
No, then the question was, if you cut indirect taxes or if you cut the tax rates on fuel items, you will be actually losing resources. But we began the debate with adding or garnering more resources. So we need to be very clear of the objective, whether we want more resources, whether we want to spend those resources to keep fiscal deficit and borrowing unchanged, or we want to reduce fiscal deficit. Because everything cannot be achieved. That's what I'm trying to say. The government has clearly told us that I want my fiscal deficit to be closer to 4.5% 4 or 5 years down the line. Now, either they will have to change that target itself, which means then they will have a space to spend more. Right. But then, as I mentioned...
In any case, Professor Mehrotra, government has to put money in one pocket after taking it out from another one. I want to give you the last one. I'm completely out of time now.
No, I just want to say with all due respect to my good friend Nikhil, that he oversimplified the argument that I was making. I'm saying, and that Aditya and I are actually making, that we need to cut indirect taxes, but we need to mobilize more resources through direct tax revenues, and thereby offset that and spend more. These are the two ways forward. And all three actions would be actually complementary to each other. They will all stimulate demand.
Okay.
And at the same time,
Professor Arun Kumar also wanted to make a point. 10 seconds, sir.
Private investment will rise.
Just very quickly, we must have a policy.
Professor Arun Kumar, 10 seconds only, please.
The policy should be, who do we target? The poor people are not the ones who are being taxed. Okay, they are being taxed by indirect taxes, and therefore they are the ones, if we target them, then we have to reduce indirect taxes. We can't say that, look, what will happen to the fiscal deficit. Is fiscal deficit more important than 94% who are in the unorganized sector? So I don't think that targeting should be on fiscal deficit. Targeting should be the crisis is there, and in this crisis, how do we get out of it? I think that's more important.
Absolutely. Thank you very much, all of you, for joining us here on Urban Debate on Mirror Now. It was a pleasure to have you on the show today, and some interesting suggestions also came out. We can really hope that things get better and the government is listening, because the current situation clearly needs some out-of-the-box solutions, given the uncertain times that we are all in right now. With this, we will slip into a very, very short break, but there's lots lined up for you on the other side as well. Stay with us.